Good afternoon, viewers at home. Welcome again this week to another insightful episode of Insights from Eximators Legal. My name is Esther, your host. Today we want to discuss another aspect, continuing our series in tax law. Last week we discussed the concepts of taxation under the law. What is taxation? What are the principles of tax basically under the common law? Using Nigeria as a case study, and we discussed the major taxes available in Nigeria. We discussed some of the reasons why these taxes are imposed. Today, we are continuing in this series and we'll be discussing an interesting technical aspect of tax law, which we call the concept of tax avoidance and tax evasion. What is tax avoidance? What do we mean by tax evasion? Write down with me as we discuss in this series. So basically we've explained that tax is a mandatory financial charge imposed on individuals or corporate bodies who are taxable persons or taxable corporates by the government of any jurisdiction as required either by a statute or by the law, which enables the government to be able to use to provide certain infrastructure in the community, in the society, in that jurisdiction. So tax is basically mandatory. It's not a voluntary thing that, yes, I might decide to pay tax. No. If you're a taxable individual or a taxable corporate body, such is required and mandated under the law to pay tax. However, the concept of tax avoidance and tax evasion has its roots also under tax law. So tax avoidance and tax evasion, they are forms of tax non-compliance. And tax is a legal, it has its basis in law majorly. And when you avoid tax, you are not complying with the law, which requires you to pay tax. When you are evading tax, there is also a non-compliance. However, there's a distinction between the two in terms of the fact that both terms lies in the legality. So the distinction between the two lies in the legality between tax avoidance and tax evasion. Under the law, there are technical grounds for a taxable person, a taxable corporate, to avoid tax payments, and which could be legal if there is a basis for it, which the law provides for. However, under tax evasion is an illegality in the sense that it's a criminal act and it is punishable under the law. So tax avoidance, what is tax avoidance? Is a reduction of the taxable income or tax due to be paid through legal means. So if somebody is, or a corporate body, is meant to pay tax of a particular amount, reducing the tax through legal means would be tax avoidance, and there will be basis for it. So the taxable individual or taxable entity could structure their business or their affairs in such a way that it precludes them from paying the full amount of the tax due. That is tax avoidance, and that could be lawful under the law. However, tax evasion is the unlawful means of concealing taxable income from the tax authorities so as not to remit taxes. So in a situation where a taxable person refuses criminally with the intention of not disclosing certain income to the government in its business in order to evade tax, that's a criminal act and is punishable under the law. So we see the difference that one has to do with reducing your tax payable, another has to do with concealing information about your taxable income, which invariably gives the person the room not to pay tax on certain income because those incomes were not disclosed. So that's tax evasion. So the duty to pay tax, ideally, as we said last week, is a duty that dates back to centuries. So it's not just a recent thing. Tax is lawful to be paid from the taxable corporates or the taxable persons in the society to the coffers of the government. So it's a pecuniary burden, ideally laid upon either the individuals or the juristic persons to support the government in their expenses. So, having said this, let's go into the nitty-gritty of tax avoidance, of tax evasion. What are the bases for it? What does the law say about this in details? So tax avoidance, like we have established earlier, is not illegal. Under the law, there are technical grounds that the law provides in which a taxable person could avoid paying tax. The law gives room for the taxable persons to reduce its tax based on certain things, of course, in the legal way. So like we said, tax avoidance is not illegal. It's often done by clever taxable persons or entities who minimize their taxable incomes by taking advantage of the loopholes in the tax laws. So it's the lawful means of altering a person's taxable income in order to reduce the amount of tax payable. Is usually achieved by claiming certain tax deductions or tax credits, which is provided for under the law. So if somebody is wise enough and clever enough to go into the tax law and check for the loopholes, maybe via the help of their tax consultants, they could reduce their tax payable, and that is lawful under the law, and that is deemed tax avoidance, which is not illegal. So it involves some sound financial planning on the part of the taxable person or the taxable corporate body. So there are financial planning techniques that could be deployed or employed that will eventually lead to reduction, taking advantage of tax reduction. For instance, under the capital gains tax, there is a way that on certain properties you may not have to pay tax. You may not have to pay that percentage. And you know, some have defined the capital gains tax as a lawful trick towards the circumvention of tax payments. So we see in a situation where somebody sells a property, ideally, he's supposed to pay certain taxes on those income that comes in on that property. But he could take advantage of certain provisions of the law, depending on, okay, what type of property did they sell? Is it a non-profit organization that sold the property? Or are they selling in the name of a non-profit organization, even if that property actually is owned by a body corporate, which is not even a non-profit organization? So all this requires sound financial planning. And that's why most tax lawyers, tax consultants, understands the loophole in these laws, and they are able to help their clients to make use of them, to maximize those opportunities under the tax law, to be able to reduce their tax payable to the government. There's a case which we're going to discuss, really, and it's an English case. It's called the case of Ashia Pullman Motors Services and the Commissioner of Inland Revenue. So it explains in details the meaning of tax avoidance. The Lord Justice in that case ruled when he held and said no man in this country is under the smallest obligation, moral or otherwise, so to arrange his legal relations to his business or to his property as to enable the Inland Revenue to put the largest possible shovel into his stores. The Inland Revenue in that case is the tax authority of that jurisdiction. It goes on to say the Inland Revenue is not slow and quite rightly to take every advantage which is open to it under the taxing statutes for the purpose of depleting the taxpayer's pocket. And the taxpayer is in like manner entitled to be astute to prevent so far as he honestly can the depletion of his means by the revenue, which invariably means the taxpayer should be wise enough not to allow the tax authorities to rip him off and should be able to take advantage of opportunities provided under the tax laws to reduce its taxes. So this ruling, in this case, justifies the legality of tax avoidance. It emphasizes fairness or justice in permitting a citizen of a country to be clever in managing his income or taking advantage of the tax laws, just as the tax administrative bodies or tax authorities also are allowed to take advantage under the tax laws. So both the tax authority have their own opportunities open to them under the tax law. However, the taxpayer as well has opportunities under the tax law to reduce his taxes, and these are known to the tax authorities. In another way, tax avoidance is very legal to the extent that it involves using the tax laws to reduce the tax liability under the law. So examples of tax avoidance would be taking advantage of some allowable expenses which are provided for under the tax law. So when you submit claims for the expenses in earning the income, thereby reducing the income to be taxed, that's tax avoidance. There are certain allowable deductions under the tax law, and a clever taxpayer, if they can identify those allowable expenses, would have deducted those expenses before even arriving at taxable income, thereby reducing the tax burden. Also, there are instances in certain jurisdictions that provides for, we could increase the number of children. Of course, it might not be an issue of lying, no. So one has to be very careful. There could be a thin line between lying and tax avoidance, really. But some, they could increase the number of their dependents to be able to take advantage of tax deductions. Some will take advantage of tax deductions by seeking professional advice. And that is where the tax consultants comes in to help plan these things and take advantage of the loopholes under the law. Tax evasion, on the other hand, as we said, is a criminal act. Under criminal law, there are two bases that has to be established before an act can be termed to be a crime. The Latin word says mens rea and actus reus. Mens rea means, does he have the mental intent to commit the crime? And actus reus was the act actually committed. When it comes to tax evasion, the taxpayer has to be able to have the intention to commit the crime, to evade tax by concealing information about the income that is taxable in its business or its affairs. And also, that act also of not declaring also will be carried out. So both bases of a crime will definitely play out under tax evasion. So it's a deliberate refusal to pay tax or underpayment of a tax. There's a difference between reducing your taxable income and underpaying what you're supposed to pay because there's a concealment of fact. And that concealment of fact is the evasion when it comes to tax evasion. So it's been interpreted as an illegal practice where a taxable person or a taxable corporate deliberately evades paying their authentic or real tax liability. So tax evasion can be defined as a deliberate practice of not declaring the full taxable income in order to pay at a very minimal rate or a very reduced rate criminally. This is internationally a violation of the tax law. And it is very, very important to state this. It's the use of illegal methods of concealing income or information from the tax authorities, and it could result in fines, penalties, even in jail time. So the difference between tax evasion and tax avoidance largely boils down to two major elements, which is either lying or hiding. So with tax avoidance, you're structuring your affairs so that at least the least possible amount is paid by taking advantage of what the law allows. But with tax evasion, there's a concealment. And that's where the criminal element comes in. So moving forward, tax evasion instances would include false declaration of income, false declaration of profits actually earned, or saying no profit was even earned, deductions that are not even allowable, failure to render tax returns to the relevant tax authority would also mean tax evasion. I want to look at some cases under the law in real terms and in practice in which some of these issues have played out. There's a particular case in television, radio, and ESBIR where the defaulter in that case failed to render tax returns to the relevant tax authority, and the court held, amongst other things, that the tax being scoffed over was the tax of the appellant's employees from certain years. And we see these things play out seriously because even in practice, we see a lot of employees deduct taxes from a lot of employers deduct taxes from their employees' salaries and not remitting to the government. That is a criminal act, pure and simple. Yes, some could say, okay, yes, under the law, they have certain times to file. But when it is beyond a particular period allowable under the law, it becomes a crime. And you see most organizations, even in reality, especially in developing nations, fall prey to these things. And in this particular case of television, radio, and ESBIR, the employer had actually been deducting tax for over 5 years from his employees' salaries and not remitting. He failed to remit to the appropriate authority. And according to the court, the ruling says this is a despicable way for any taxpayer to act. And of course, it's detrimental to the development of such a nation, because the monies that is supposed to add to the infrastructural development via tax is not being remitted. At the end of the day, the economy also suffers. And this is very, very, instructive for organizations, for individuals. Because when the organization or the individual is not remitting its tax as at when due, it also tells on the revenue of the government. So a tax evader would ordinarily be charged to court, if caught, and when caught, and could be fined or imprisoned. A case study using Nigeria. Section 40 of the Federal Inland Revenue Service Act actually makes tax evasion punishable under the law in Nigeria, and is a criminal offense under Section 41 of the same act. To prevent the tax authorities from carrying out their duties in this regard. What could be the reasons why some would avoid tax or evade tax? Well, some would think, okay, what's the government really doing for us? I may not necessarily pay tax, it doesn't matter. Some will be, okay, let me reduce my tax. At least the law allows for it. Some would rather not pay at all, which is the criminal part. There's also the mismanagement of funds realized from tax remittance. And the government also has to be very careful when it comes to this. Some lack knowledge of their civic responsibility. Some take advantage of the legality of tax avoidance. But there are also effects of tax avoidance and tax evasion on any economy, which we have also explained. It reduces the revenue of a country when its due taxpayers are not remitting the proper taxes that should be paid, or they are not even remitting at all. And it could affect the economic development of such a jurisdiction. So it's very, very instructive to know that taxes are part of revenue for infrastructure in any jurisdiction. And it is key and important for taxable persons to, at least to a large extent, structure their finance in remitting the proper tax due, even where they are taking advantage of the loopholes under the law. Certain jurisdictions have made provisions within its laws to ensure that tax avoidance or tax evasion is tackled. Even in Nigeria, certain new provisions have come up, like under the Personal Income Tax Act, which now removes certain allowances that have been there before that taxpayers have been leveraging on in the past. So under the new Finance Act year 2020 in Nigeria, it now removes the provision of Section 34 of the Personal Income Tax Act, for instance, under sub 4 to 6, which grants the issue of children and dependent relatives allowances, is now been deleted under the Finance Act. Of course, this is not favorable to taxable persons who would fraudulently increase the number of their children to be able to reduce the tax payable. But because the government have seen people are taking undue advantage of these things, they will also tackle the loopholes by restructuring some aspects of the law to ensure that people actually declare, to a large extent, the fair or the true and fair view of their position per time. We also see certain instances under the Value-Added Tax Act. In Nigeria now, we're talking about the way Nigeria has been able to tackle, which provides certain punitive measures for non-compliance with the need to register with the Federal Land Revenue Service for the purpose of tax. And that is very instructive in ensuring that taxpayers or taxable persons are not evading tax unnecessarily. So at times, we see that the way the laws also are couched could give the taxable persons the leverage or the opportunity to either evade tax or avoid taxes. And most governments have now seen that if you give people 1 mile, they'll take 2 miles. So they have to tackle these issues also with the law by making certain amendments. And that's what, for instance, the Finance Act 2020 in Nigeria have been able to do, to remove certain sections of some allowable expenses which ordinarily some taxpayers would claim under the personal income tax in the past. Under the Value-Added Tax Act, certain provisions have also been completely substituted to ensure, that taxable companies register with the Federal Land Revenue Service on their vatable goods and services. So basically, tax avoidance and tax evasion could be hampering the growth of a nation where they have been unduly leveraged on. And so it's very, very important for tax authorities to ensure that all these loopholes are managed properly by reviewing the tax laws to ensure that, at least to a large extent, taxable persons declare their taxes, as the case may be. And like we have explained, a short while ago, Nigeria has been able to do that in recent times by the recent Finance Act of the year 2020, which now allows more disclosure and seals up certain loopholes that taxpayers have been leveraging on to avoid taxes. So today, we've been able to discuss majorly the concept of tax avoidance and the concept of tax evasion. Tax avoidance in a lot of jurisdictions and under the tax laws are legal within the ambit of the tax law if certain loopholes or certain options given under the tax law are leveraged on to reduce the taxable income. However, tax evasion is a criminal act and it's punishable under the law. So we'll move on in our series, again in our next episode, about taxes, because there are still certain aspects to discuss. How do we plan a tax? What does the law say about tax planning? How permissible is tax planning under the law? We'll discuss the issue of value-added taxes, looking at certain jurisdictions as our case study. So we believe today you've enjoyed this session, and we look forward to seeing you again in our next episode. Have a lovely weekend, and God bless.